Excited to introduce Nathan Willis, our Director of Portfolio Strategy here at OneAscent Investments, to give us an update from our investment committee and outlook for the balance of the quarter. Nathan?
Thanks, Cole, and good morning, everybody. It's a pleasure to be here talking with you. What we're going to do today is talk about what happened in the quarter, but first I want to frame it by talking a little bit about our portfolio process, and we call this slide Navigating the Ups and Downs of the Market. So the first piece of your portfolio is strategic. It doesn't really change very much, and it's risk-based. It kind of sets the amount of stocks and bonds you have in the portfolio. And then we add to that, around the outside, what we call the navigation, which is our tactical work we do, and we update this every month with an objective assessment of the health of the global markets. And I think that the navigator or the navigation wording is apt right now, because in the first quarter it kind of feels like we're in a small sailboat getting battered around by the waves, and it doesn't feel great. But we make tactical moves, slight tactical moves that help keep us going in the right direction. So we're going to talk more about that towards the end, but I wanted to kind of lead in with the framework of how this works, and that also helps us remember how the work that Stephen and his team at Nuveen is doing fits into our portfolios. So what are we going to talk about? First of all, we're going to talk about what happened in the markets in the first quarter, because a lot happened. Not much of it was good. Second, we're going to talk about what caused the market movements. Then we're going to have a little history lesson to look at a couple of periods, two historical periods that bear some resemblance to what's going on in the market today. And then we're going to talk about how this is affecting my portfolio, which I know is very important to everybody. So first, I'm going to put on a slide here, and it's got a lot of information on it. But this is from Morningstar, and it shows market performance for the first quarter of a bunch of different sectors. And there's a lot of red on here, very little green. And the reason for that is that increased inflation expectations paired with expensive valuations led to this downdraft, right? We've been talking about valuations being expensive for a couple of years. But what I want to do is point you to a couple of particular things on this slide. First of all, the only way you made money, really, was in energy. And that was because of the oil shock, because of the Ukraine war. So energy, primarily driven by fossil fuel companies, was up 40% or so. Utilities also made some money, but those were the only sectors that actually made money during the first quarter. Energy is a big component of the value index, much more than the growth index. And so you saw that value actually made money this year so far, whereas growth is down 12%, right? And it's actually kind of striking when you look at the other pieces of this section of the chart. The U.S. market was down 5% or more. Developed markets without the U.S. was down about 5%, and emerging markets was down 6%. You might want to say, well, I mean, that portfolio should be down 5 or 6%. But unless you owned these companies that are cheap, you didn't benefit. And we aren't going to own something just because it's cheap. A lot of times, what's cheap is cheap for a reason. And so our portfolios, I'll tell you, we're a little bit less exposed to that. And so our equity performance was a little worse. We were down closer to 10% in most of our equity portfolios. And the reason for that is we tend to have less exposure to energy and more exposure to transformational areas that are represented by this section in the bottom right. So we have more communication services, cyclical, and technology exposure. And that has hurt our portfolios during the first quarter. But we'll talk about the fact that that has helped our portfolios for years, and we expect it to continue to. The one last thing I'll point out, Stephen already talked about the fact that fixed income lost a lot of money, and it was the second worst start to the year since the Depression. But one thing I really want to kind of focus on in here is the fact that treasuries lost 10%. 10-year and longer treasuries, those are supposed to be the safe ones, right? Well, they lost money, and that's really because of inflation expectations. So why didn't the market work, quote unquote, the way we want it to? As I said, there are two things: inflation and valuations, right? So let's dig into both of them. But before we do that, I'm going to talk about my son. On his 3rd birthday, he decided that he ought to have 3 pieces of cake. I'm not sure why my wife and I let him do that, but at about 2 o'clock in the morning, we realized that was a bad move because he threw up. And so when we were up there changing his sheets and changing his pajamas, he was sitting on my lap and he said, "Daddy, I think I shouldn't have eaten 3 pieces of cake." And I said, "I think you're right." Well, cake at your birthday is a little bit like inflation. A little bit's really good, but 3 pieces of it makes you throw up. And that's kind of what happened in the first quarter. The markets kind of threw up because too much inflation was happening. But let's think about that. Stephen talked about the fact that we think expectations are going to come down. We think inflation is going to come down. This chart that we're looking at illustrates the same kind of thought, but from a survey of consumers. This is a chart produced by the New York Fed, and they survey consumers about their expectations for inflation. And the blue line says they expect inflation to be 6, maybe even 7% a year from now or over the next year. But if you look at the red line, that is their expectation for 3 years from now. And you can see that's already come back down. It's below 4. It's around 3 to 3.5% or so. A little bit higher than the Fed's goal of 2%, but still moderate in the long term. So we don't think inflation is going to be continuing, and it's going to be a huge problem. The second thing that we are worried about, or that hurt stocks in the first quarter, are valuations. So high valuations have left stocks vulnerable. Continuing my son's analogy, he's not that old yet, but high valuations kind of make me think about a junior high kid, right? He's driven by emotion a lot and makes irrational moves. And that's what happens when stocks are priced expensively. They tend to react more to emotion. So this slide here shows us the price to earnings ratio, so in a sense, the valuation of the stock market. And it goes all the way back to before the tech bubble, and I think that's important. The red line here is U.S. large cap stocks represented by the S&P 500. And you can see it was incredibly expensive leading into the tech bubble. The blue and the green lines are small and mid cap stocks. And you can see back in the tech bubble, they were not very expensive at all. And they actually did pretty well right until the end of that recession. A similar dynamic, but not as overstated, is occurring in the market now. We've been talking for a couple of years that U.S. large cap stocks are pretty expensive. And they've been more expensive than they've been since the tech bubble burst, right? However, for the last couple of years, small and mid-cap stocks have been less expensive. And you can see over the course of 2021, even before the market started to tank in 2022, both large cap and the combination of small and mid-cap stocks have gotten cheaper. That's because earnings have done really, really well. And you can see they've gotten more cheap now. Large cap stocks are still expensive, though. We're not going to say they're not. You can see even today, they're higher than their 20-year average, except for during the tech bubble. But small mid-cap stocks appear pretty attractive. If you look at where the blue and green lines are, they're pretty close to the low over the last 20 years. So we feel pretty good about the fact that being diversified outside of only large cap stocks is pretty effective. So the two things that hurt the stock market in the first quarter were inflation and valuations. But I want to touch base on one of the things that the market is very worried about and why inflation and high valuations really hurt. And that's what the Fed is going to do. We talked about that with Stephen. And is the Fed going to kick us into recession? This chart makes you think they might. And so this is a historical chart going back to the 50s of the Fed funds rate. So the blue line going up means the Fed is increasing rates. And the gray shadow lines are recessions. And it kind of feels like there's a pretty good pattern here where the Fed increases rates and they do it too much. It's acknowledged that it's hard to run an economy, but they raise rates too much, and then eventually that kicks us into a recession. So that's what the market is worried about right now. So let's take these three things and put them all together, okay? So we talked about inflation, we've talked about stocks, and we've talked about the Fed increasing rates, okay? So what I want to do is show a chart here that appears a little bit different. This might not be a chart you're used to looking at, but it's called a drawdown chart. So what we do is you can see there's a zero and the line never goes above zero. So we actually don't care in this chart when stocks are going up. All we care is when they get to a peak, they start coming down. How far down do they go? And then how long does it take to get back to that peak? That's what we care about on this chart. And it's pretty instructive. What I've shown here is U.S. large cap value stocks in blue and U.S. large cap growth stocks in red. And I think it is very telling. And I want to share a couple of historical parallels here that I think give us some sense of where we might go. So first of all, let's look at where we are today. In the current market, growth was down 12% for the first quarter, and value actually made money, right? So it lost money, made it all back, and then went above zero, which we don't really focus on in this line. But there are two historical parallels, and I want to look at them. The first one is about valuations, and that's obviously the tech bubble. So back in the tech bubble, we had extreme valuations. It was all focused in the large cap growth names, and you see large cap growth stocks, that red line, lost 54% from the top in 2000. Value stocks, large cap value stocks, and small and mid did even better, but large cap value stocks were down about 2/3 of that amount in the mid to high 30s. What's the next historical parallel? The next historical parallel deals with inflation, because we haven't really had inflation since the 70s, and that relates to the oil embargo that was at least part of that. So let's go back to a high inflation period of the 70s. And you can see when the Fed started raising rates there, growth actually was down 54% as well. That's not a typo. They both rounded to 54. One was 53.8, one was 53.6. So it's kind of amusing that they were down the same. But what I wanted to do was point this out, and I wanted to say, are we set up for a market like that today? And we think the answer is no, right? In the absence of high market valuations of the tech bubble, we don't think they're nearly as high, we've shown that, or the high inflation of the 1970s oil shock period, which we don't think inflation is going to be that high. We think it, our business partners think it, and the New York Fed shows us that consumers think it. Inflation won't be that high. So outside of those two circumstances, we actually don't think we're going to see significant further downside. If you look at this chart of where growth stocks are today, they're down about 12%. You might remember from information that we've shared with you on a regular basis, the average drawdown on the market is about 14% a year. So really, we've just had an average drawdown. So this really isn't something that is triggering our worry that it's going to get a lot worse. What I want to do now is share a couple of facts about those two periods and hope that we can kind of illustrate it a little bit further. So first of all, let's look at the 73, 74 oil shock. What I'm going to focus on here is returns in the stock market. So in that middle group there of information, we look at the market leaders, and I just pulled the top 5 out. So IBM, Eastman Kodak, Sears, GE, and Xerox. And those companies, their average PE was 36. If you remember back, that was the time of the Nifty 50, where there was these 50 stocks, and they were considered by everybody who invested to be, quote, one decision stocks, where you just bought them and you never had to look back. The PE of those Nifty 50 were 42 times. A little bit higher, actually, than the current leaders of the market. Apple, Amazon, Microsoft, Alphabet, and Meta are at a 33 times PE. Couple things to point out here. First of all, look at Eastman Kodak, Sears, GE, and Xerox. Much more industrial companies, much lower margins, much more capital intensive, whereas today's leaders are much more information focused and service oriented, and a higher PE is actually very justified. The second thing I want to point out is just having a high PE doesn't mean you're going to do poorly. It makes it harder to do well, but it doesn't mean you're going to lose money for sure. So I'm going to take two companies and illustrate that. So people have done studies that said after this crisis in 73, 74, how did these companies perform from the peak? So IBM and GE were two. IBM actually outperformed the S&P 500 from the peak of 1973 for the next 25 years until 1997, whereas GE actually underperformed the stock market. And when you look at the whole group, there was a decent number who outperformed the S&P and a decent number who underperformed the S&P. So just having a high PE doesn't mean you're guaranteed to lose money. It makes it a little riskier, and it makes the case for what we do, which is having an outside expert managing those portfolios. It's a really important part of what we do. The second comparison is the technology bubble. I already talked about things being pretty expensive. The S&P 500 growth PE ratio was 40 times in 1999. Today, now, at the end of December, it peaked about 30, a little bit below 30. It's now about 25. So we're nowhere near as expensive. And then what I want to point out here is the market cap share in the earnings share. So the market cap share is this. Those 5 companies back in the tech bubble Microsoft, Cisco, Intel, Oracle, and Lucent. They were the top 5 then. They were 16% of the S&P 500 market cap, but they were only 8% of the actual earnings power of the market. So they had double the share of the market than they had of the earnings. That's not the situation now. The top 5, Apple, Amazon, Microsoft, Alphabet, and Meta, are 20% rather of the S&P 500 market cap, but they're 17% of the earnings, almost the same amount of earnings power as they are market cap. So it's really not a fantastic parallel, and one that we think is actually provides a lot less to worry about. So we've talked about the fact that the market is worried about inflation, stock valuations, and the Fed. We've talked about that we don't believe the 2 historical parallels where growth stocks really got hurt are apt. But what I want to do now is talk about your portfolio. In order to do that, we're going to take a quick ride through our Navigator Outlook. It's kind of our anchor. Every quarter, every month, every week, we actually look at our Navigator. So let's talk about what the Navigator is telling us here. First of all, it won't surprise you to hear that we think stocks are expensive. They have been for a couple of years, and we've seen that. Second, let's move to the economy. We're calling the economy neutral right now because earnings are really good, even though they're coming down from last year, but there's a lot of risks. We haven't really talked about the war in Ukraine, but that's a significant risk to the economy. And the other risk to the economy is that the Fed makes what's called a policy error. In other words, they raise rates too much because they started too late. They raise rates too much, and that knocks us into a recession. So we're going to say neutral on that. The technicals, long-term, favor risk assets, so that's pretty good. And sentiment, up until last week or so, was kind of red. It was not fantastic because the University of Michigan Consumer Sentiment, which is a survey of consumers' expectations for the economy, has been incredibly negative. But at the same time, in the last couple of weeks, investor sentiment has gotten very, very, very bearish, with only, I think, 15% of respondents being bullish. In general, the fewer number of people who are bullish, the better. It means there's opportunity for stocks to go up. So overall, we kind of feel like we're pretty much neutral on the economy. So I want to get back to the original analogy I made about the Navigator, where it feels like we're in a boat being knocked around by the water a little bit. One of the things I will also say is sometimes when you're sailing into the wind, you've got to kind of go off to the left or off to the right and tack back and forth. And it may always look like you're going where you want to end up. But I want to give you confidence that we are going to a place that is good, and we're going to meet goals that these portfolios are designed to meet. In order to do that, I'm going to talk a little bit about the allocations in your portfolio. Then I'm going to talk about the long-term performance. So first of all, we talk about the fact that we have 5 risk-based models, and we're going to focus on the moderate model. What we've done since this started, we've made a couple of tactical adjustments. First of all, we have shortened the duration of our fixed income portfolio, so we will be hurt less if rates do continue to go up. We've bought a little bit of inflation-protected bonds, which will help us in case inflation does continue to go up. And we've reduced risk slightly. Last quarter, we were at just ever so slightly above neutral. In a 60-40 portfolio, we were 62% stocks, and we've dropped that down to be about 58% stocks. We feel like we're relatively neutral still. We've got a little bit of dry powder. So I wanted to make sure you knew that we've made a couple of minor adjustments, but it's important that we don't make drastic adjustments. The Navigator is not here to make huge adjustments. We're not market timers. We're going to stick to the plan, and we have confidence in the plan. And we have good evidence that the plan works over the long term. So we can look at any one of these performances, but I'm going to look right in the middle here at that moderate allocation. So you can see right in the center of your sheet of paper that the year-to-date performance of that allocation is down 8.7%, 3% worse than its benchmark. And the reason for that is really because our stocks had a little bit of a growthier bias and got hurt more. But it's important to remember where we're going is good and it's solid, and we have a long-term performance to prove that. We have 5-year numbers now. The firm is 5 years old. It's really exciting for us. And so our 5-year returns for that portfolio are just under 1% ahead of the moderate benchmark. Across all of the portfolios, we're essentially even to as much as 1% ahead. So we feel very good about our portfolio positioning. We want to make sure you feel confident in our process because we do. and we're making some slight adjustments to make sure we're going in the right place.